Hazer Group has developed a proprietary hydrogen production technology based on methane pyrolysis. This process is unique in that the carbon byproduct is captured as graphitic carbon, essentially eliminating process greenhouse gas emissions. A commercial development plant in Perth came online last year, further demonstrating the feasibility of the Hazer process. Importantly, the technology leverages existing natural gas pipeline and LNG infrastructure and therefore is not reliant on major technical advances in the hydrogen supply chain. The company is strongly positioned to provide decarbonisation solutions for existing hydrogen production methods and also participate more broadly in market growth driven by steel manufacturing and transport sectors. Managing Director Glenn Corrie is online to take us through the Hazer Group opportunity. Thank you, Glenn.
Thanks, Stu. Great to be here. Good morning, everyone. I'm going to jump straight in if that's all right. And as Stu said, I think we're the most exciting, a little bit biased company in the climate technology and the clean hydrogen ecosystem. Hazer stands for it's the name of the company, of course, but it's an acronym as well for Hydrogen and Zero Emissions Research. That was the vision of our company close to 2 decades ago. That's the reality of where we are today. We're at the forefront of the energy transition. We're at the forefront of the clean hydrogen transition and the clean hydrogen sector. And there's a beautiful picture there of our commercial demonstration plant, as Stu said, in Perth. If you're in town, please reach out. It's a wonderful experience to visit that. To most people's surprise, it is actually the second largest clean hydrogen production system in Australia. So that sort of shows, in some respects, the maturity of where we are as a company, the impact that we're having, and the progression that we're making as a climate technology. First and foremost, I like to start with this because we're not green hydrogen, we're decarbonising gas. We are effectively a world-leading climate technology that accelerates the pathway to a very affordable and fast transition to clean hydrogen at scale. A couple of key words in here worth pointing out. We're decarbonising gas. We're using existing supply chains to locally produce hydrogen for a client or a customer. And that's very different from transporting hydrogen around the world. So we're taking and removing the carbon from gas. I'll speak to the advancement of it in terms of our world-leading position as a climate technology. And I want to underline affordable as well. We can deliver hydrogen in the US today for about $1 a kilogram, plus or minus, but it's a very low position on the cost curve that puts us in a very competitive position relative to not just our peers, but also those that are operating in the clean hydrogen and the green hydrogen space. A bit of a recap on our technology. We're a classic methane pyrolysis technology. We effectively take a methane-rich gas. It could be LNG, it could be biogas, a wastewater treatment gas, LNG, and we effectively convert it and split it into two very valuable products, clean hydrogen and carbon in the form of graphite. That's the removal of the carbon from gas. The X factor that we bring to all this, of course, is the use of a catalyst. It's the iron ore catalyst that we use in our process. It's affordable, it's abundant, it doesn't have a cost impact on our technology, but it has one very important characteristic then, that it reduces our operating temperatures down to between 800 and 900 degrees Celsius, and that is substantially lower than most of the other, if not all of the other processes that are operating in this space. We're one technology that serves three very valuable markets: the clean hydrogen market, the carbon market through graphite, which is a critical mineral, and industry decarbonisation. To get a little bit technical on you for a moment, we use a fluid bed reactor in our process. Why I mention that is because that's our proven pathway to scale. If you've been around refining or metallurgical processes for some time, you'll appreciate that fluid bed reactors have been a big part of the scale up of those processes. And for us to adopt that into the Hazer process has enabled us to see a pathway to very, very big scales, 50,000 to 100,000 tonnes per annum, which is where you really need to be for some of the big industrial and hard to abate sectors like steel, cement, ammonia, methanol, petrochemicals industry. So a really exciting technology that is very well advanced at this stage. Moving on to our competitive advantages, I won't spend a lot of time talking through these because I think the presentation does a very good job of explaining them, but we're in very advanced TRL. For those that follow TRL, it means technology readiness. We're approached 7 now, we're moving into 8. We're low cost. I want to show you some really compelling cost pictures relative to the sector. I talked about fluid bed reactors and our proven scalability. That's crucial when it comes to climate techs and your ability to get to large scale and that scalability. Graphite's unique, and it is a co-product. And we have a very exciting partnership there with Mitsui, one of the leaders in trading of co-products and carbon products around the world. We're plug-in, as I said, we integrate with existing supply chains to provide hydrogen, locally produced hydrogen to a customer at their demand point. Very important and crucial point to remove cost out of the system. And first commercial advantage and first mover advantage in big markets with tier one corporations around the world that we're very excited about. We had a great quarter last quarter. In fact, we had a very good year. And you can see some of the highlights from the quarter itself. But suffice to say, we enter this year, 2025, with a substantially de-risked technology, a growing and expanding portfolio and pipeline of strategic partners, clients, customers, strategic investors that are exploring the opportunity of working with us. And we also have a very robust funding position as a result of some important non-dilutive inflows that we received late last year in the form of our R&D cash refund, as well as a very sizable grant from the Western Australian government and the Gorgon Fund of $6.2 million, which I'll talk to very shortly. So a really strong position to enter into the year with. Strategically, we feel like we're on track. We've got that nice foundation now of commercialization in the bag, and that is setting us up for a focus this year to continue that momentum of building on that technology de-risking that's gone on over the last 2 years, and now pushing us into the scale up and the monetization of our technology. So a really important foundation for us, and their focus very much now is on selling the technology and commercializing it with not just the partners that we have, but that deep and that evolving pipeline that we have and that we're developing real time. So in terms of our technology readiness, many of you have seen this before. We've been on this journey for close to 20 years. Okay, it's effectively $120 million of investment in this technology. It's a substantial amount of money to scale this technology 5 times very successfully. Okay, we started on a bench back in 2007. Every 2 or 3 years, we've been able to scale this technology up to now commercial demonstration level, which is that picture on the right. And that picture behind me and it's TRL 7, Technology Readiness Level 7. We're going into 8. That's a very advanced climate technology and one that is ready for commercial deployment. And of course, we've got that near-term pipeline of opportunities that have been really waiting to see the results from our CDP. And we're now very excited about the ability to now take those results and feed that into the designs of all of those projects and others that we've got in our pipeline. In terms of the CDP itself, we had a very successful test program last year. It was 12 months. We actually finished it and completed it ahead of schedule. We are now at a place where we've got a substantially de-risked commercial technology. We operated last year for almost, in fact, over 1,250 hours of continuous operation and continuous catalyst feed and hydrogen production and graphite production. So a very important milestone, cracking through that 1,000-hour of operations. Our uptimes and our production uptimes and our plant uptimes are very high. On average, across the entire campaign, was over 95 to 96%. Our last run, which is over 450 hours, we had a production uptime of 99%. So very high numbers, strong reliability, a good handle on what we call solids handling of the graphite, which can be an issue. But importantly, some very important results that have come out of that in terms of our gas conversions, which have now looking very positively over 95%. And the performance of our CDP has matched our model. And so that confidence provides well, those results provide very strong confidence in the commercial readiness of our technology. So we've got a load of graphite, which we're also have bagged up to and sent to many of the customers. But very importantly, if you throw all that into an economic model and a cost model, we've been able to confirm confidently the economic viability and the competitiveness of our technology. If you look at the chart on the left, this is a good example of where Hazer can operate in the US. We can deliver hydrogen today to a customer in the US for around $1 a kilogram. That's a third of the cost of blue hydrogen, and that is comfortably a seventh of the cost of green hydrogen, which uses electrolyzers, and that excludes transportation. So we're very low on the cost curve. We think there's room to go even lower with optimizations, economies of scale, higher graphite prices in the future, and that's going to put further downward pressure on our cost base and increase that margin for a customer and a client that uses our technology, but also put more blue water between us and the competition. So a really exciting place, and being able to confirm these economics and our cost picture is a credit to the CDP and the technology itself. In terms of our portfolio, we've made great progress with Canada. It's our first big commercial project. It's owned 100% by FortisBC, a very large gas utility of $30-40 billion market capitalization. We've been strongly supported by the Canadian government here. They have thrown in $8 million to get us, or the project at least, through to final investment decision. Site selection is going very well. I think the company has got a number of sites, in fact, 3 sites identified. That feasibility work's going on at the moment. And we've just passed a very important milestone there with the testing of the reactor pilot test rig, which again confirms the larger scale reactor and its readiness for commercial deployment. So project's on track to finish feed this year, which is an important milestone for final investment decision. Alongside of that, we've also got a building portfolio. We've got a project in Japan with Chubu Electric, the world's largest LNG importer, a project in France and Europe with ENGIE, one of the biggest utilities across that space, and also, very excitingly, a strategic partnership with POSCO, the world's 6th largest steelmaker in Korea, to integrate Hazer technology into steelmaking. So all of those represent very unique applications of our technology: power generation, bitumen and asphalt for our graphite, blending of hydrogen, and also steelmaking represent sort of the corner points of how we can impact hard to abate sectors. Behind all that, I was looking at our pipeline a couple of years ago, and we only had 5 or 6 customers that were, looking at Hazer's technology. Now we can say that we've got over 30 customers or client possibilities in our pipeline of strategic partners, big industrial groups that want to deploy our technology, as well as strategic investors across those strategic markets of North America, Europe, and Asia Pacific. To give you insight into sort of what that portfolio looks like, it's probably focused around about 50% in Asia Pacific, 30% in North America, and the rest in Europe and the Middle East. So it's a good geographical spread. There's at least 5 steel companies that are exploring the technology. Oil and gas majors and oil and gas operators, of course, see the decarbonisation potential of the technology as well. And if you aggregate our pipeline today into terms of total volume of possible hydrogen production, it amounts to about 1 million tonnes per annum of production. And if you look at that in the context of the entire hydrogen market, that's close to 1% of what it is today. So it's a big portfolio that's growing in strategic markets with what we'd say is tier 1 large corporations that are looking for decarbonisation solutions for their existing business. Graphite, critical mineral. If it's probably a surprise to many of you that graphite is in the top 10 critical minerals for the US. It's also in the top 10 critical minerals for Australia, but it is also a mineral that's not produced in either country. So it is a situation that is a little bit of a risk for many countries around the world, because the supply side for graphite is controlled by China. It controls up to 90% of the world's graphite production. So being able to have a technology that can produce large volumes of of graphite is a real advantage. For every unit of hydrogen, we actually have 3.5 units of graphite. So it could be a big supply side disruption for the global graphite market as well. And we are very proud to be working with Mitsui, one of the largest traders, at least in Japan, if not globally, to explore and develop the markets for Hazer's technology, in particular the graphite side of it. It's a very unique graphite product. It's high purity. It's low emissions, of course, because it's decarbonizing gas. It's got high thermal electrical conductivity. It fits very nicely into thermal energy storage. And of course, that low sulfur and ash content means it also fits wonderfully into steel making. We've done a lot of work over the last, I would say, 2 to 3 years. We've just extended that strategic partnership with Mitsui and come up with what we consider to be our high graded markets and industry application list, ranging from concrete, steel, asphalt, bitumen, thermal energy storage, water purification, as well as some other potential applications. But you can see very quickly that the drop-in potential for Hazer graphite is strong and high. It means very little post-processing, and the pricing ranges are anywhere between $200, $300 a ton. This is in US dollars, and up to over $1,000 a ton. So a really exciting product at a really good time. It's a critical mineral for many markets around the world, and it's a big input to EV batteries and many other applications. So yeah, a really big value kicker potentially for our technology alongside the clean hydrogen product. Our business model is CapEx light. We've spent $120 million getting to where we are today. We've got a model whereby our future capital requirements are very, very limited. We've taken the tech now to commercial development levels. We're about licensing our technology to customers. All of those portfolio projects that we've got are all under license agreements. And that is the model that we see as the most feasible for Hazer at this stage. It's a combination of engineering fees, pre-FID, license fees, post-FID, and then post-production, of course, production royalties. That's the model that we have effectively developed based on a number of technologies that have been down this pathway before. But that CapEx light model means that we have minimal capital outflows going forward. We don't own positions in projects, and it enables that early access to free cash flow. We are already receiving revenues from our first commercial project in Canada, and we expect that to be the model going forward as all of those projects continue to mature and stack up that revenue profile for the company. But having that first revenue inflows into the company has been a big milestone for us as our technology matures. Now, if you throw all that into an economic model, you see that an indicative plant will look like this. Fairly low upfront capital requirements, but fairly substantive cash coming through the hydrogen as well as the graphite side. You can see the returns there for a plant owner. They're very attractive. A plant of this scale at 50,000 tons per annum, which could be representative of an industry-sized plant, would throw off in the order of $400 to $500 million of NPV for the client. But more importantly, for Hazer in the orange box, every single plant that is operating in the world today would effectively yield in the order of $100 million of license fees and royalty fees for us as an NPV. And so that gives you some context in terms of the size of the prize for Hazer as a platform. It takes very few of these projects and plants around the world to be a large platform. And if you just take that 10 or 15 projects in the pipeline that we've got that are, potentially near term to medium term, then this could easily be a $500 million to a $1 billion platform just based on the royalty model. So that's the size of the prize that we're hunting for. It's a small chunk of the market that's available today, and with that low cost characteristic that we've got and our maturity, we believe we are on the strong pathway to deploy the technology at scale in the near term. In terms of a corporate update, IP, we're very well protected globally across at least 32 jurisdictions around the world, under 70 patents. So what all that means in simple terms is it's very hard to copy what Hazer's doing. We've been at this over 15 years. We've got that big, extensive IP portfolio, and we continue to see IP progression through that portfolio as we mature the technology. Corporately, we ended the year with a very strong cash position. I think publicly we were $9 to $9.5 million. We've received the first 2 million of our government grant from the Western Australian government, which has been sponsored by the Gorgon joint venture, puts us in a very robust financial position as we drive through some of those big strategic milestones this year, and gives us that extended runway for our 2025 work program. We've got a really exciting program this year. It's focused on 3 things. It's about commercialization, accelerating that reactor and getting it up to large-scale commercial deployment levels. Of course, monetizing that graphite is going to give visibility to not just us, but the shareholders and the investment community on the real value of graphite. Accelerating our scale-up, Canada, driving that forward to a final investment decision, unlocking those other commercial projects we've got, and then digging deep into that portfolio, that big portfolio of projects and strategic partnerships are there. And I'm very confident that at least 1 or 2 of those could be very big inflection points for the company this year. And of course, we run a lean organization. We're 25 people building one of the world's best climate technologies. We run under a continuous improvement culture and have that foundation of a strong financial position as we run into the year. Stu, I think that's a great place to stop. That's our investment thesis there. But I'd really keen to jump into the Q&A.
Great, thanks very much, Glenn. I'll kick it off with the Fortis project, and obviously that's going through FEED at the moment, FID thereafter. What, in terms of scale up from what you're doing at the moment in Perth, how big is that? You know, how many more times the size is that, and what are the risks around that scale up, do you think?
Great question. It's a 25 times scale up, and we've been in that scale up area before, so it's not as big as we've been, but it's a commercial scale, and we're actually been testing the reactor for that scale up. So we're very confident coming out of the CDP that we can go 25, 30 times, 40 times larger from where we are today with our existing reactor. We've always said the reactor that's going to be used in that particular project can be scaled up to 30,000 to 40,000 tons per annum. The project in Canada, the first phase, is only 2,500. So it's an easy jump for us. The project is advancing well. We've got a great partner. As I said, they own something like 50,000 kilometres of pipeline in Vancouver, and they supply gas to the entire region. British Columbia is very supportive of hydrogen. Hazer, you may have seen in the press recently that the project just went through a fairly substantive milestone there with the reactor testing on the ground. And that is a key milestone for the scale-up potential. But the FEED has been done. It's waiting for the final site to be selected. Then the FEED will be completed, and then they'll go into FID and construction.
Fantastic. You know, Fortis, Chubu, Mitsui, POSCO, Engie, like pretty amazing list of counterparties. Which one is next after the Fortis one?
It's a good question. Look, we've got to have a portfolio, Stu, because we're early stage, but I think the portfolio and those names that you just mentioned are a strong validation of what we're doing as a tech. It drives us to continue to advance it because we're seeing demand for the tech from not just those customers, but potentially others. Look, if you look at our portfolio, our aspired portfolio is steel making, which I think will be a large proportion of it. Big sector, big problem. It'll definitely be ammonia and refining because that's today the 2 sectors that hydrogen serves. And for those not aware, the hydrogen market is massive. It's 100 million tons per annum today. That's a quarter of the size of the LNG market. Half of that is used for refining, half of it's used for ammonia, and it's all dirty hydrogen. Every ton of hydrogen produced is 10 tons of CO2. That's our disruption. I'd like to see more steel, more ammonia, a bit of methanol, power generation, and of course, petrochemicals. So that's probably the top 5, Stu, but a 30-30-30 approach to the portfolio. I think our existing portfolio sort of starts to show that through POSCO, Engie, Chubu in the gas side, as well as Fortis in the blending side. So I think it's evolving nicely, but I'm confident what I've seen in the portfolio today that there's going to be a couple of big new customers come through, shortly to sort of, again, just continue to validate the technology that we've got.
Obviously, steelmaking and transport are probably the two newer applications of hydrogen use. And as you mentioned before, the real incumbent use of hydrogen in that market is around ammonia and methane reporting and reforming in the refinery space.
Yep.
That seems like the easiest market to grab. How do you see replacing SMR technology in refineries as a competitive advantage for you?
We think it's low hanging fruit. And the reason is because we are almost cost parity with steam methane reforming. And that is a really big, important point. Being low on the cost curve means that customers and clients have a very low switching cost across to Hazer. And the fact that we use the same feedstock, we plug in like an SMR plant, and we disrupt with clean hydrogen as opposed to CO2 dominated hydrogen, I think is the real disruption. We've got live active discussions with refiners and petrochemical firms to see that benefit. Of course, they're big companies that we deal with, multi-billion-dollar companies, and so they have their own timelines. But it's refining and ammonia is ripe for disruption, and that's one of the big target markets for us. And we're confident that we see enough in the pipeline to give us, the excitement about the fact that we will have a project in at least each of those sectors in the near term.
And just in terms of, you mentioned you're almost at cost parity with SMR technologies in the refining space. I presume that's before you take into account the costs of a carbon, carbon bill
That's
for
right.
the SMR technology.
Yep. And those economics that I showed, actually, I should have mentioned that they don't include any subsidies. We don't really need subsidies, but of course we'll take them. And that we don't take any credit in there for carbon offset, which could be a big one, depending on where you are in the world. If you're in Asia, it could be $100, $200 a ton. In Canada, carbon dioxide could be priced at $300 to $400 a ton. So, like I say, we're one technology that serves three markets: the hydrogen market, of course, the clean hydrogen market, the graphite market, and also industry decarbonisation, because there's a really big carbon offset that our technology can bring to bear. When we do our process, we have zero carbon emissions, so that's a really important point to add.
And in your feasibility study work, how much value do you put on the graphite opportunity, or is that clearly a byproduct and potential upside?
We see it as upside too. We continue to drive down the levelized cost of hydrogen as a single product. The graphite is a real value kicker. Now, if you put $600 a ton on it, the economics just go off the chart. So we try to be relatively conservative on this, but we see the potential in it. The partnership with Mitsui, extending that is, again, strong endorsement of what the product quality is like. We have shipped now hundreds of kilograms to prospective customers around the world just recently. We're getting really good feedback on briquetting of it, moving it around, logistics. We're getting really good feedback on the use of it in asphalt and bitumen, as well as thermal energy storage. So it's an area that that we're watching very closely. We see it as great time for graphite with the constraints on the supply side in the market. It is a critical mineral. The Australian government recently came out just in the last few days with the Senate passing the tax incentives on the critical mineral side as well as hydrogen. So there's a lot of emphasis on it from a government perspective, as well as in not just in Australia but also in the US.
Great. Look, Glenn, that's all we've got time for. Obviously, a pretty exciting year ahead, with particularly that Fortescue progressing forward. But we really appreciate you being part of our conference today. So thanks very much.
Thanks, Stuart. Thanks, everybody.